Mack from Accenture, and I'm here to talk numbers. So it's normally a hard thing in the middle of the afternoon, and as you may be aware, we have a wine reception coming out, so I have the challenge of keeping you interested in numbers for the next little while. It's more than just numbers, though. It's funding, and it's mergers and acquisitions for the cloud. And so hopefully that captures your attention. I'm going to ask the panelists to come up here quickly, and or when at your leisure. We're missing one person, Ellen Powell from Kleiner Perkins, and she'll be here in just a moment. And Lars Leckie from Winblad, unfortunately, had to pull out at the very last minute, so apologize for that. So let's just give it another minute here, see if we can get Ellen back in. And do we have some slides? Great. All right, well, while we're waiting, so my focus at Accenture, I'm in the management consulting organization. I focus on strategy and mergers and acquisitions for the technology sector. My focus is really mobility, cloud, and big data, and where those three themes come together. So we're here to talk about M&A. One of my colleagues from our M&A practice, John Kinnaman, is here somewhere. John, wave your hand. So we're here to talk about mergers and acquisitions as part of what we're talking about, part of our theme today, the other part of the theme being funding. So sequentially, funding comes before M&A. And Ellen, thank you very much. Our panelists today have different perspectives on both, and we'll let them introduce themselves in a second. Ellen Powell from Kleiner Perkins. Mike Abbott couldn't make it at the absolute last minute, but Ellen was so kind as to step in and represent Kleiner. Jeff Hinck from Icon Venture Partners, and Julie Reigel from Wilson Sonsini. So let me let each of you introduce yourself, just say a little bit about your angle on funding and mergers and acquisitions and cloud, how you see it briefly from your vantage points.
Should I start?
Sure.
Yeah, so Jeff Hinck, a general partner with Icon Venture Partners, been a venture capitalist since 1997, invest strictly in the enterprise, and that's what our firm does as well. Primarily early stage is where we get started, Series A, seed investments, and have a couple investments in cloud infrastructure with Joyent and Stratus, and then probably over a dozen in the SaaS field.
Please.
Hi, I'm Julia Reigel. I'm a partner at Wilson Sonsini, Goodrich, and Rosati. I tend to represent startups, but also small public companies, and take them through that process, both in the M&A and the fundraising space, and have been practicing for 16 years.
I'm Ellen Powell. I'm a partner at Kleiner Perkins, and I work with the enterprise team to invest. We've been very active in enterprise investing. We've invested over $100 million in the last 18 months in enterprise startups, and announced recently that we're going to invest another $100 million in the next 12 to 18 months. We've been active on the early stage side with seed investing and Series A investing, all the way up through the late stage side. Recently, we invested in DocuSign and App Dynamics out of our digital growth fund, which is a later stage targeted fund run by Mary Meeker.
Great, thank you. So of all the things we could talk about here, we're going to try to just keep this simple and then get to your Q&A. Really 4 topics. So funding for the cloud segment, M&A for the cloud segment, kind of how the market dynamics work and market strategy around these themes, and then what do the panelists think the outlook portends for the next 3 to 5 years. 5 years is probably too long to talk in tech, but 3 years at least. Just to ground us a little bit, I'm going to go quickly through some data, and I wanted to thank Brendan Daly and his team at 451 Research for collaborating with Accenture on the data. Just briefly, the numbers always change depending on your interpretation of what's really a SaaS transaction or platform or infrastructure as a service transaction, but the shape of these graphs shouldn't be a surprise. What you see is most of the activity, M&A activity, is in the SaaS side, on the SaaS side. When you think about that, that makes sense. A lot of point solutions, vertical-specific solutions, solutions tailored to really solving a particular industry problem. So that's where most of the companies are, and that's where most of the merger and acquisition activity is. You see hardly any activity on the platform as a service side, and some bumpiness in the infrastructure side. So we also see that on the SaaS side, the pace of activity has slowed down. It's 37% CAGR for the first half of the time series here, and that's slowed down to, I think, 8% for the second half. Take a look at the size, the transaction value. And we're looking at infrastructure, not platform, just because there's just such a paucity of reported data for platform as a service transactions. But we're looking at the transaction value and then the valuation. So it's kind of hard to make sense of this just looking at this. So we're going to add some color there. But what you see here is over time, this is the average for each of those years, 2009 through 2012 year to date, end of August. So we see it's moved around a little bit. We also see that the entire SaaS range is templated over there on the right, and really infrastructure tends to command a higher valuation and value. If you look at the movement here, you see a divergence. You see that in 2009 with the diamond, valuations actually decreased in the subsequent year for SaaS, increased in 2010 for infrastructure, and then started kind of going back in the same direction here in 2012. So just setting a little context there to start with. Depending how you define software as a service and platform and infrastructure, what's a pure play SaaS or PaaS or infrastructure as a service play, you may have different names, but some names that you'll see that you recognize up here, and you see the different years of where the deals have happened. So some major deals happening in this year so far. The year's not over, so one more quarter to see what that holds. And this is in descending order of value. So you see some familiar names that have really kind of reshaped things a little bit over the last few years. That's on the SaaS side. And then on the platform and infrastructure side, some other names. So again, depending how you define the segment, some of these names may disappear, may not be on here, or may. And with that, let's open up to the panel. Switch microphones here. Let's start with funding, since that's where a company has to focus initially. Start with you, Jeff. Just from your perspective, what do you see as the key drivers of VC funding for cloud companies, and what do you see as some of the major distinctions between these three segments that we discussed?
Yeah, so I mean, the primary driver obviously gets, at the end of the day, it's driven by what we see in the customer set, in the enterprises, right? All these things are being sold eventually to enterprise customers, and I think we're really in the pretty early innings of a you said 5 years being too long, but candidly, the cloud stuff will roll out for the next 20 years. As they're really the infrastructure within enterprises is increasingly going to the cloud, both externally, but even internally. And right now, if you look at the Fortune 500, it's probably 1% of their IT, right? So it's pretty de minimis today, but it's one of those rising tides that lifts all boats. So I think that's fundamentally, we think there's a long-term driver in play. SaaS is obviously the most mature of those three, though. When I see things like 3PAR being called infrastructure as a service, I guess you could say EMC is too, right? So so I'm not sure where those definitions were coming, but SaaS is obviously, those companies are largest and the most mature, and something all of us have been funding for a number of years. I think the PaaS and the infrastructure as a service is a little newer. The adoption curve in the Fortune 500 is clearly, there's much less of it. It's just kind of starting with a lot of those companies today. So that's earlier innings, I would say, than SaaS, clearly, but something that we see being pretty fundamental over the next several years.
Thank you. Julie, you have a slightly different perspective, just what comes across your desk. You're advising also in very early stage transactions, but from the funding side, what do you see as really the key drivers of value in the deals you're seeing?
I think the key driver of value is who the people are, what their experience has been, and whether investors see them as either a point solution, in which case they're not going to raise a lot of money, or sort of a long-term play, and how that would fit in with an industry that is always, of course, consolidating. And so we are seeing a lot of Series A rounds, which is very good news, and seeing a lot of people consistently getting funded, which is also good.
And Ellen, what do you see as the key value drivers, and what does Kleiner look for in particular for a deal that you want to fund?
And we look for team. I think what Julia said is very true. We're looking for folks who have a different background than the folks that we invested in 10 years ago. It's much less the seasoned 20, 30-year executive from IBM or HP or Oracle. It's really these new folks who are coming out of Salesforce, coming out of VMware, coming out of the infrastructure teams at Facebook or Google. A lot of my friends from BEA have started companies, and they've been very compelling. But it's a different, more dynamic type of entrepreneur who's really focused on this new opportunity, where it's no longer the monolithic entity that's selling in with these 10-year relationships, but it's really consumers, employee consumers going out and adopting new software and trying to figure out, what they can download onto their phones or download onto their computers very quickly and to solve a real problem. And you see a new set of entrepreneurs coming out to solve that need. And that's what's been driving a lot of value. Are they looking at a big enough problem? Are they teamed up in a way that's going to be able to execute against that problem? And do they have a clear sense of the value that they bring to the customer?
Thinking further about maybe the life cycle of funding a cloud company, now that's also changed a little bit in the last few years. How are you, direct this at you first, Ellen, but how are you seeing that shifting? We hear a lot about, say, Google buying an entire company of 5 people, maybe just for the IP, for the developers. And maybe we're also hearing about crowdsourcing or crowdfunding rather, and not a lot of interest in venture capital formally, at least until a later stage. So are you seeing, how is that dynamic affecting you, I guess, is the question.
It's interesting because I think there are a lot more people that are interested in enterprise than there were 10 years ago. So if you look 10 years ago, it was just these folks coming out of these big established companies, and now there's a whole new generation of entrepreneurs, and we see so much more supply of interesting ventures. It takes less capital to get to success. It takes less time, as you mentioned, because I don't have to build up that huge sales force and go run through these 6-month sales cycles. Somebody can just download something, or I can use it and test it out, and I pay as I use it. It's a very different environment than it was several years ago, and things are moving faster. There is a movement more towards self-funding. There are a lot of very wealthy angels out there, but there's just so much opportunity out there. We haven't seen, we've just invested in $100 million, and we're looking to put another $100 million to work. So there's a lot of opportunity out there. We're very excited about the folks who are doing really interesting things, and just the greenfield nature of opportunity. You're not going head-to-head against incumbents because you're looking at a SaaS play, which is completely different from what people are selling to before.
Interesting. Julie, do you have a perspective on the funding life cycle?
I do. I'm not seeing much crowdsourcing, but I am seeing a ton of angels, particularly angels that are in the industry, and I think that has enabled many of these companies to go to the next step and get venture funding or be an acquisition candidate because they lend some credibility to the enterprise that they might not have if it's 4 30-year-old guys in a garage.
About what you're seeing, life cycle.
Yeah, I mean, I agree on the front end there being more bootstrapping and whatnot, just because, development technologies have changed so much. What used to take $5 million before you'd have the product out the door today, we have the last company, we funded, they had 4 customers, 4 months into it with 4 people, right? So, I mean, it was, so that certainly has changed. And as a result, the acquirers are coming in earlier, right? They're trying to, the acqui-hires are clearly happening. It's still, more the exception than the rule, to be honest. But you do see, the strategics trying to get involved earlier, trying to get an earlier, perspective on what's happening with the companies than they used to.
Yeah, certainly IBM has been really forward-thinking in that regard in terms of the strategics. Now, we saw the data was very skewed towards SaaS, and it's not a surprise to any of us. Do you think that implies a saturation in the market, at least at the SaaS end of the market? Are we starting to get saturated, and there's going to be some shakeout, and maybe funding is be choosier than ever before because we're kind of moving towards a later stage, or are we just getting more micro-segmented, and this is just healthy evolution of the SaaS segment? Maybe Ellen, do you want to?
It's interesting because it's the billion-dollar question. Should we continue to invest in a lot of SaaS companies, or have we missed the cycle? I think there's still a lot of opportunity. There's still a lot of companies that are customers who are looking for better solutions. I don't think all of these companies are going to survive, but there is a lot of opportunity, and we're definitely actively looking to invest in SaaS. It will be interesting to see what happens. Not everybody's going to make money, but there are going to be a few companies that come out of it, and you look and see what Salesforce is. They're moving far up the food chain, and they'll be a formidable competitor for some of these companies. But there's still a lot of opportunity where the new technology, the new platforms, and the lack of incumbents is going to drive a lot of successful new companies.
Jeff, what do you see? Is there still opportunity, or is it harder to really pick the winners in the SaaS segment?
No, well, I think there's definitely plenty of opportunity. I think that what's happened is the space has changed a little bit. I mean, if you went back 5 years ago or whatever, when you had, the beginnings of some of these companies, they were basically taking existing software categories and now coming up with a SaaS version of it, right? I think a lot of those opportunities are gone. That's become more mature, but when you look at areas like gamification, right, it's just like we funded, did a seed funding of Badgeville, and then they went on to raise a couple other rounds recently. Company in the gamification space. Well, that didn't exist ever really in the software space, right? That's a whole new category. It happens to be SaaS, but it's a new category, right? So I think there's plenty of new categories that will continue to be created in SaaS. I think just, hey, here's CRM, now we're going to do a SaaS version of it. Those opportunities are less obvious today, but the new categories, yeah, that'll keep on going.
And some companies are filling in the stack or filling in
yeah,
point
absolutely.
solutions
I mean,
still.
just like software was, it's been a 30-year investment process. Well, that'll continue. It's just more often it's SaaS now rather than licensed software.
Now, shifting gears entirely from funding over to M&A, which doesn't always happen, but Julie, I know you focus a lot on M&A. Similar question to what we led with what are some of the key value drivers for funding? What do you see as some of the key value drivers in successful M&A transactions?
I think it greatly varies between sort of the hardware side of the shop and the infrastructure side of the shop and the SaaS side of the shop. On the infrastructure side, there's a lot of consolidation going on. 3PAR was sort of the tip of the iceberg, and there have been a lot of private company deals subsequent to that have commanded valuations because of 3PAR and the deals that came before it. I also see on the infrastructure side a lot of companies wanting to not do necessarily acqui-hires, but fill in solutions at the point where somebody's in a beta testing stage. It's clear that there's a product there. They maybe have a few customers signed up, but they're not waiting for them to see if they're making money, and that's because the infrastructure side as a whole is really consolidating and doing it very quickly. On the SaaS side, we see a lot of strategic investors wanting to come in, do a round of financing, and then as part of that get rights to participate in a negotiation down the road to buy the company, maybe couple that with a commercial agreement. And so a lot of tension there in the M&A process is, can the issuer get to the point where they can actually do an auction without having their on one hand benefactor standing over them and not deterring other people. And I think venture investors are a very good sort of natural predator to those companies because they keep them honest. If you have an angel-backed company, it's much harder. And so for those tuck-in acquisitions, people tend to end up with the person they came to the dance with.
Nicely put. Now, the venture perspective, when we talk about venture and M&A, it's kind of, is it fair to say it's kind of the baton handoff when you're exiting to a strategic, for example? When you're doing that, what do you see as some of the key complexities that you've encountered in executing that kind of transaction for a SaaS company or platform or infrastructure specifically? Do you want to start?
Oh, sure. I mean, well, obviously the first complexity is valuation, right? You got to get past that before there's a deal. But then otherwise, I think actually a lot of the complexity happens after the acquisition, right? Where they find out, can they really keep the team? Does that, culture work? And of course, most times it doesn't. They, replace the people or, do something and they, work less frequently than they would like to, especially, the smaller ones that they often, find a way to snuff out. But, in the process of closing the deals, at least most of the venture-backed ones, I mean, there's not you'd mentioned some of the complexities in like legal due diligence or, IP and things like that. A lot of times the companies aren't to such a size that there's a whole lot of stuff buried, in the weeds on, a lot of venture-backed deals where there might be more of with a large public company or something like that you're acquiring. So, I think a lot of it is just, personalities, at the end of the day after you get past the valuation question, and do the personalities work, and does the technology? I mean, assuming they've crossed that chasm already, right? That works for the architecture vision that the acquirer has.
Hopefully, by the time there's an M&A
Yeah, you
transaction
think.
established,
It's not always apparent that they've thought that through, but.
Right.
Yeah.
Ellen, how about you?
I'd say the biggest piece is keeping the team motivated. It's a different group of entrepreneurs that's getting acquired these days, and it's not the folks who have come out of big companies and are used to the big company environment. So bringing on a team, and these teams are getting younger, in to work at a big company can be very challenging. The idea of going to work for an IBM or an HP is just not very appealing. So trying to figure out how you're going to keep that team there long enough to get the product to be successful within the big organization is a huge challenge.
Now, we mentioned valuations. You just mentioned a second ago. What are your perspectives on valuations in the current market? It seems to be getting frothy. We've had success factors in Taleo kicking off the year, and it seems to just be more of a feeding frenzy now. Is that what you're seeing, and do you see that persisting?
Well, they're certainly pretty high, and I think there's no reason why it won't persist for some period of time. Certainly, and part of the reason is all these guys are, if you look at all the majors, they're all competing in multiple segments where they used to not be, right? I mean, especially if you're throwing in all the hardware and infrastructure, right? I mean, you used to have Cisco and networking, and HP was up in the servers, and now everybody's across everybody's, space, and so as a result, you used to have one or two natural acquirers, or you could go public, and today, you can have 8 acquirers. Heck, you even have some companies where you got private equity firms competing in the mix too, so it's, causing the prices to, to go up to higher levels, clearly. So, yeah, it's a good point in the cycle, I think, to be selling.
Definitely a convergence, and everyone's in each other's space now.
Yeah,
Suddenly.
yeah, they really are.
Julia, what are you seeing?
I think one thing that's affecting valuation and pushing it up is a lot of companies, as they mature, are sort of taking a dual path. They're filing a registration statement, getting ready to go public, and then seeing if acquirers pop out of the woodwork, because obviously from an exit strategy, being acquired is a much more certain transaction for the investors. But if they've got the opportunity to go to public market, at least before what happened in late May, they were confident that they would get a better valuation. And so trying to hybridize that approach, where you basically have a private company that's doing a public company deal, is something that I'm seeing more and more of.
It's also interesting because they're competing with the public markets, as you mentioned, and the public markets have been really strong for enterprise IPOs. If you look at the performance of enterprise IPOs over 90 days, they've gone up by 50%. The consumer IPOs have gone down by 6 or 7%. So if you look at where the money is going in the public markets, it becomes very competitive for acquirers to try to get these companies at a reasonable valuation as an acquisition, because the alternative of going public is quite strong. So you've got to compete with that, and I think also it's just an interesting time because the business model is so strong. If you look at SaaS, instead of having to go out and get 10 new customers every quarter in order to hit my number, because every quarter I'm starting from 0 revenue base, I've got this base of customers that's paying every month, every quarter, that continues as my core revenue stream, and then I just need to get new customers to get me that 30% growth.
We touched on this a little bit earlier, but that's graph that for the SaaS companies, it just shows the huge skewness towards that side of the market, and thinking what drives valuation, competitive differentiation is a big part of that. How do you see that kind of evolving? How do you see it now? Are we starting to get to the point where there's just an inability to differentiate, or is there still juice in the lemon?
In terms of
competitive differentiation and the ability to drive valuation, it sounds like, I guess we kind of addressed this already in terms of it's like it seems to be kind of a feeding frenzy right now. If you haven't gotten in through a deal, you get in through a deal now.
But you can see there's certain teams which are much stronger than other teams. There are certain businesses where they're much more aggressive about driving revenues, and they're focused on what's my new ACV every quarter, and I'm not looking at the total revenue numbers. I'm solely focused on my growth numbers. and there are products where they're hitting huge markets with less competition than other markets. You can differentiate on product, you can differentiate on team, less so on business model.
I think one of the other things that's driving sort of valuations is that you have a lot of smaller companies that haven't built up a customer base. So from a earnings standpoint, they don't really have earnings yet. The buyer is basically looking at a way to fill their channel.
Yeah, even Salesforce has a different way of looking at earnings in maybe a non-traditional way while they continue to do their acquisitions. So that's interesting as well to contemplate. Now, we talked about the skewness towards the SaaS side of the spectrum and the kind of relative paucity of deals on the infrastructure platform side. Do you think that data picture has any implications for how standards are going to evolve on the platform and infrastructure as a service side of cloud computing? There, obviously, the further up you go towards platform and infrastructure, there are fewer companies. But what does that picture about the relative lack of deals on that side tell us or imply, perhaps, about standards evolving?
I don't know if it's so much about standards as it is about competing against some of the incumbents that are in that space. Amazon has done a really nice job on the infrastructure side, and they've got a lot of scale, they've got a lot of customers, they've got the brand awareness. When companies start, they set up an AWS instance and they run with it, and it's very hard to switch off that. So, when we look at that infrastructure sector, we're really trying to figure out, well, how are they going to compete and beat Amazon or be in a space where Amazon is not? So that's an area where it's very tough. And then also on the platform side, you've got Salesforce, you've got a bunch of other competitors that are, that have been there, and it's less of a greenfield, I think.
Well, it's also far more, capital intensive, certainly on the infrastructure side, right? I mean, it's Verizon that'll be competing against, Amazon rather than a startup, typically speaking. So there's a lot fewer of them, to your point, which is clearly part of it. And then I think there's a lot of companies that are building tools around the things that, the Amazons and the likes are doing. The other part of it is, if you look at where the Fortune 500 spend is, today they're not doing as much on the cloud basis. When they start doing more on the private cloud, you'll also start to see more tools and more companies come into play on the infrastructure, than you will today. So I think you will see an increase in that, but I don't think there'll ever be quite the same numbers as there are just in a broader application base like SaaS.
Fair.
One thing that we're seeing as well, though, however, on the infrastructure side and on the platform side, is that there's a lot more intellectual property litigation happening. People using patents competitively.
Definitely, everyone seems to be in that game now. And codecs are available for cheap if anyone's buying. In the interest of time, we want to allow a couple minutes for audience questions. Let me just try to wrap up with, I'm going to fold two questions into one if you don't mind. So your perspectives on the outlook next 3 to 5 years, if you can see out that far, for both funding and for M&A. Just how do you see some of these themes that we've discussed playing out?
Well, I think both of them will be very robust. I mean, obviously the reason, we're here today and this all got convened is, in the enterprise space, this is a very attractive place to invest and will continue to be certainly in that time frame, and I think well beyond that. I mean, it's kind of the, next evolution of IT within the enterprises to, cloud-based infrastructure. So, I think it'll be great for both, funding and M&A will continue to be. Not that there won't be plenty of losers, there will be, but there's going to be a lot of, good winners created over the next several years.
And no big cliff necessarily.
Well, I don't think so. I mean, I think there really is kind of an open opportunity set, right? And clearly, the incumbents are buying in the space. The incumbents oftentimes are also, confused when they think Ariba's advancing them in the cloud space. I think they're kind of missing what really the cloud is about. But, so then they'll have to come back and buy cloud companies too.
Julie, what do you think?
I think as people use more of these systems, they're going to find more problems, and people will need to step in and to solve them. So I'm optimistic.
Yeah. It's a change in how people are doing business, and that's something that's being captured by technology. And this change, regardless of what happens to the economy, is moving forward. So there's a lot of value being created, and it may be a shift of dollars into different types of enterprise software instead of a growth in dollars going into it. But there is a lot of value and a lot of money being saved through all of these new technologies. So I think it will continue.
and the title of our conference here is The Cloud at Scale, and we saw from the Forrester numbers that we opened up with this morning that there's still a lot that has to play out. There's still a lot of under penetration, so I think that makes sense. Let's open it up to questions. Do we have a microphone circulating around? I think we do. Microphone is coming, so you get the first one here.
Good afternoon. My name is Edward Strickland. I'm an IBM global entrepreneur. My question is that in cloud requires tailored solutions for clients, and going open standard can prove that the usage fee can be less expensive than going the API route. So binary standards, Linux-based, causes some complexity in the deal flow because of the intellectual property, who owns it, who's contributed to it. Do you see that happening now, Julia?
What I see is a lot of discussion about what kind of open standard people are using, and there's good and there's bad. There's also, how the company is monitoring what they're doing. Do they really know what they have and what they've used and who owns it and what their rights and obligations are? So I do see a lot of it being used. I see buyers not being scared off by it, but they want people to, be responsible, understand the differences, and to make sure that they have systems in place to protect them from using open source information that would, impair the value of their own IP.
And the reason why I ask is because when the enterprise does its acquisition of a particular product, they want to have full ownership. And that's something that the proprietary part that they want to have, and that can be complex. So the deal may not be as good as it appears because it may be a great solution, but it may not be attainable.
But the interest, oh, sorry, Dr. Go ahead.
Yes, go ahead.
We do see a lot of discussion about purchase price adjustments when the extent of the open source reliance is diligenced.
What we've seen is a lot of the enterprise customers want open source. They don't want to have proprietary software that they can't switch off. So there's been a big push from the purchasing side to try to, that makes the product creators want to be on more towards the open source side.
Next question. I think I see one in the back here on the edge.
Hi, I was wondering if any of you could share your thoughts around PaaS companies and their and the metrics around them when it comes to funding and also exits.
That was PaaS with a P?
Yeah.
Okay. Who wants to take platform as a service funding and exits? We didn't see a lot of deals there, and there's the deals that we have numbers for we don't have the transaction value for. So I know you see a lot of things that aren't made public, though.
Yeah, I mean, I don't think there have been a great number of them that haven't been, that have been very large, that haven't been public. I mean, most of them have been, I think fairly well disclosed. There hasn't been as many of them. It's just the bottom line, right? I mean, I think you're starting to see more tools around things that enable, hybrid clouds and things like that. But on the pure, PaaS things like the Herokus and stuff like that got bought, I think those are all public, and there haven't been a lot of them. Is the bottom line.
So do you think the trend is still?
Yeah, no, it's certainly a lot earlier than SaaS, right? I mean, a lot of the SaaS companies are very substantial in size. If you look at the PaaS ones that aren't already large companies, a lot of them are nowhere close to where some of the SaaS companies are. So yeah, I think you'll see more activity, in the future, certainly in that segment. Though, like I said, personally, I believe more of it's going to be derivative tools that are, than actual, PaaS companies. But.
And it's a little bit less on the revenue side, and it's much more on the amount of adoption.
Yeah, absolutely.
Other questions over here on the far side?
Hello, my name is Bruce Templeton. I'm the CEO of a company by the name of Nefoscale out of San Jose. We're a public cloud infrastructure company. And question I have about indemnification. So we get some prospective clients that are worried about software indemnification. They're used to using VMware, for instance, where they feel like the provider, VMware, is backing them from a legal standpoint. So they're concerned sometimes about open source. So for instance, we run on KVM. We've considered running on KVM Enterprise. So there's Zen Server, KVM Enterprise, and VMware. They're all paid for licenses that are indemnified by the development company. So my question, and somewhat Red Hat, and they won't run CentOS, which is the open source version of Red Hat. Do you see some loosening in that area as far as the enterprises and their concern about indemnification and their openness towards open source?
I'll take that because I assume it's directed at me. One of the things that we see is that customers are really expecting a high level of service if they're paying a high level for the service. And you have different issues depending on whether you're in the public cloud or the private cloud. If you're in the public cloud, it's very hard to sort of reach détente on indemnification between the provider and the customer because the risks are substantially greater. If you're in a private cloud, I think there's a pretty well-worn path on what kind of indemnity the provider is going to give to the customer.
I think we have time for one more question if there is one. Are we questioned out? It's been a long day. All right, going once, going twice. All right, well, let me shift over here then. All right, well, I think I have the keynote for the wine reception. That's my next duty today. So on behalf of Accenture and SVForum, let me first thank the panelists. Round of applause. Also, on behalf of SVForum and Accenture, thank you all for coming today. It's been a phenomenal event. We hope you found a lot of value in it, made a lot of good connections, and learned something new. And now we hope you enjoy a glass of wine with us down the hall here. So thank you.